This is a follow-on episode on the previous episode about evidence in investing, the role of evidence. And I want to talk specifically about evidence in financial prices, in quotes. So market prices, quotes, stock prices, can they be evidence? When are they evidence? Are they useful evidence? How should we think about that? This is Not Even Wrong podcast. It's December 17, 2020. This is Krim Delco. No additional update. The update from the previous episode of December 17 still holds. Are market prices a valid evidence for investing? The answer is no, actually. We believe that market prices, stock market prices, are not evidence to support explanations, to help us find better explanations, to error-correct explanations in the investment process. Now, this has to be unpacked because there is a fundamental discrepancy here, which is we as investors fundamentally are investing in assets, and wealth generation happens to the ascent of market prices, or if you're short, to the descent of market prices. So we absolutely depend on the development of market prices when it comes to fulfilling our mission, which is to generate wealth. However, we're also saying that those actual prices are not evidence to support our explanation. So this warrants some more specific explanation. What exactly is it we're talking about here? And I want to use one of Warren Buffett's, I think, most useful quotes, which is, in the short term, the market is a voting machine, in the long term, a waiting machine. And this is exactly what we mean. In the short term, prices are irrelevant. And this happens often in financial markets, in the media, but also amongst professional investors. They try to explain daily moves in stocks. This is futile. It has no value added whatsoever. And most importantly, it cannot influence your explanation of an investment. Now, of course, there are certain situations where certainly a daily move in the stock can have an impact on your explanation. But to be more precise, it is not the daily move of the stock. It is the explanation of the move, which then can have an impact on your actual explanation of the investment thesis. So what I mean with that is, if a company announces that they, for example, failed in developing a certain technology, that they just can't do it, and then the stock drops, then that particular stock drop is relevant and has impact on the explanation of your thesis. But of course, it's not the stock drop, it is the actual explanation for the stock drop, which is the fact that they can't develop the technology. Financial prices, quotes, are driven by, I would say, pretty impossible to explain dynamics. It's the wisdom of the crowd. It's a lot of algorithmic trading, a lot of arbitrage trading. So there's a lot of dynamics that have nothing to do with the thesis, with the explanation for why we believe that a certain company will generate wealth for us through the application of fundamentally new concepts and engineering practices with large impact, which is our mission. So, for example, Tesla on December 18th will have the last trading day before inclusion in the S&P 500. There's going to be a lot of short-term demand and supply issues that have nothing to do with the explanation for why Tesla is a wealth generator. The inclusion in the S&P 500 on its own, and I've spoken about this a while ago when the theme came up, is not a degree of freedom. It doesn't matter if the company is included or not. In fact, Tesla could be a private company and still generate a massive amount of wealth. Now, of course, there are some caveats there. For example, could they raise money as easily and stuff like that? But as far as the daily moves in the stock, as far as short-term demand and supply dynamics of the stock, which is really what the price of a stock reflects, is demand and supply dynamics. Short-term demand and supply dynamics have nothing to do with the explanation for why Tesla is a value-creating company. This is very important. Let's sink this in. The short-term dynamics of demand and supply for the stock have nothing to do with the explanation for why Tesla is a value-creating company with large impact, of course, over the long term. I think this has to sink in. This is very important. People in the markets are driven by habits that we humans have. For example, We spend our day in a 24-hour cycle. We sleep, we eat, we work. The financial markets follow that same cycle because humans follow that cycle. But wealth creation does not follow that cycle. Wealth creation is a fundamentally new, the creation of new things, the creation of fundamentally new principles with new engineering practices is a creative process. We don't understand exactly how that works. That's why we don't have an algorithm to actually do it. But we know when we see it, and it does not follow the 24-hour cycle of the sun and the day and the night and the sleep and the waking up. So we cannot follow that same trajectory when it comes to daily price moves and things like that. They have nothing to do with the actual process of wealth generation. Wealth generation can happen in a few very short periods, or to paraphrase Lenin, for a long time nothing happens, and then decades happen in a few weeks. This is how wealth is generated. This is how big events, this is how big creative events, either positive or negative. In the case of Lenin, one might argue was negative, but it doesn't matter. Big events, big changes, big disruptive changes, new concepts applied to new engineering practices, they can have massive impact in a very dislinear period of time. It can happen that we have Tesla Battery Day in September, then we have maybe a few breakthroughs here and there. We have a new AI, we have a new self-drive technology, the rewrite, and in a couple of months, there's hundreds of billions of market cap being added. The explanation for the addition of the market cap has nothing to do with demand and supply in the stock market. It is driven by the fundamental value of the company. And this leads me now to the question, okay, what is the value of the company? Because we do care about the market cap of the company, because this is essentially how we create wealth. The market cap of a company is driven by two principles. One is the replacement value of the company, and second is the cash flow. The replacement value of the company is the question, how much would it cost me to replicate this company today? Of course, it's a very difficult thing to answer, but you can have a sense, for example, is it 50 million? Is it 100 billion? Is it a trillion? And I think with Amazon, you can say, well, it's certainly in the hundreds of billions. To replicate what Amazon is doing, to get this much market share, to get this many customers, the same thing with Netflix. So you can say, completely regardless of the actual earnings and cash flows of the company, you can say that it's very difficult to replicate this company. By the way, it applies to Uber and also Airbnb, which I'm very critical of. It's difficult to replicate these companies. However, I also believe that that's precisely the reason why I think replacement value is not a good gauge for market cap, and it's not good evidence. However, I think cash flow is. And like I said, the three principles of Tesla which drive the stock and drive the value creation of the company are convenience, lower price, and cash flow. Cash flow is key. Cash flow is fundamentally important. You cannot escape cash flow. Cash flow is like gravity when it comes to wealth generation. Once you have cash flow, you can start measuring wealth generation. Once you have cash flow, there is evidence for value. Cash flow is, in a shorter period of time, can be measured by opportunity cost of capital. So if you, let's say, if for example, if Amazon generates a certain amount of cash flow, which equates, let's say, to 1% of the market cap, so the cash flow yield is 1%. So if the market cap is 100 billion and the company produces $1 billion of cash flow per year, that is a 1% cash flow yield. That can be compared to the risk-free rate, which roughly right now the 10 years about 80 basis points. And then you can argue, I can get 1% cash flow yield, or 1%. If I invest in Amazon, they throw about 1% back to me. Now, they might not give me that cash, but it is still part, as a part owner of the company, I have part ownership of that 1% of cash flow yield per year. Is that worth the same like the 85 basis points that I get per year through the 10-year treasury? And that is a subjective subject. So it's not clear in a sense. You can say, well, no, it's way too risky. I think Amazon should be a 3% cash flow yield. That means it should be, instead of 100 times cash flow, it should trade at 30 times cash flow. So the stock should be 1/3 of where it is. On the other hand, you can say, no, actually, Amazon should be 10 basis points, should trade at 1,000 times earnings, because I have a yield, I have some sort of yield, and on top of that, I have growth, which protects me from inflation. I don't have that same thing with treasuries. So that is subjective. It depends on your risk aversion, your risk appetite, and things like that. But fundamentally, I think still cash flow is a good gauge, because cash flow gives me as an investor the ability to think about, okay, what do I want? Do I want the risk-free rate for 85 basis points, or do I want, let's say in the case of Tesla, I can have pretty quickly maybe something like a 1% cash flow yield. I'm very happy with that, because I get 1%, and on top of that, I get a number of startups within Tesla that are creating fundamentally new concepts and engineering practices with large impact in several markets: energy markets, insurance markets, car markets, transportation markets, solar. There's a lot of industries that Tesla is attacking. So I have a lot of optionality, and I have a 1% yield, versus, for example, with a treasury, I have almost nothing. And then I can also compare this to other companies. By the way, when I say, again, the cash flow yield of Tesla, let's say the company is about 600 billion in market cap right now. To have a 1% yield, they need about 6 billion in cash flow, which they already have. I think next year, let's say we're looking at maybe 50 billion in sales. And if you apply a 10% cash flow margin, that will be about 5 billion. So at this rate, they could also have much higher market cap based on that cash flow yield metric. Also, again, cash flow is a little bit of a fuzzy measure, because companies tend to generate cash and then reinvest it. So as an investor, you have to be very clear about what is the cash flow through operations, and then what is by reinvested, which is kind of almost irrelevant, because you want them to reinvest. But what really matters is the cash flow from operations. And here is the beauty of the three pillars that we discussed before, which is convenience, lower price, and cash flow. Cash flow is what it's all about when it comes to measurement and evidence for the explanation for why a certain company is a wealth-generating company. Cash flow is the evidence. So cash flow is relevant. The market price is not, but cash flow is. Now, there's a link between cash flow and market price through the concept of opportunity cost of capital, risk-free rate. So you can generate an algorithm that actually is pretty accurate over decades if you go back and backtest that. So to summarize, what I'm trying to say here is really that in the end, when it comes to evidence from the marketplace as it pertains to your investment explanation, the one thing that matters is cash flow. And this is very consistent with what Jeff Bezos has been saying to his investors, which is it's all about cash flow. It's very consistent with our thesis that the Tesla milestones are convenience, lower price, and cash flow. Cash flow matters because cash flow anchors a company. Cash flow is the base on which a valuation model can be built. Cash flow determines market pricing in the stock market, and therefore there is a relationship between cash flow, stock quotes, market cap, and wealth generation. Thank you.